A few weeks ago, I joined a Chinese stock trading group. I thought people would be talking about company earnings, business models, and long-term investing. I was completely wrong. Within 30 minutes, I realized I had entered something very different. Every day, hundreds of people ask exactly the same questions. What stock should I buy tomorrow? Should I sell now? Can this stock still go higher? When the market goes up, everyone celebrates like they just won the lottery. I'm a genius. Easy money. Full position. Let's go. But when the market drops, the same people suddenly become financial experts in panic. Why is it falling? Should I cut my losses? Is the market manipulated? The funniest part? Some people don't even know what the company actually does. Someone asks, "Why is this stock falling?" Another person replies, "I don't know, but I bought it too." Then someone else says, "The group leader bought it." That is enough. No research, no business analysis, no idea what products the company sells. Just one simple reason. If everyone is buying it, I should buy it too. At that moment, I realized something. Many people are trading stocks. Very few people are investing. They are simply placing bets. People often say that the US stock market is dominated by institutions, while China's stock market is dominated by retail investors. That isn't completely true, but there is an important difference. In China, individual investors still make up most daily trading activity. In the United States, large institutions such as pension funds, mutual funds, ETFs, and insurance companies account for most trading and own a large share of the market. Because of this, American investors often ask, "Is this company worth owning?" Many Chinese retail investors ask, "Will this stock go up tomorrow?" Those are two very different questions. Institutional investors study companies. Retail investors often study candlestick charts. A fund manager may spend weeks reading financial reports, studying competition, and estimating future profits. Many retail traders spend 5 seconds looking at a green chart and say, "It's going up. Buy." The result is simple. People buy because prices go up. Prices go up because people buy. Then everyone feels like a genius. Until prices go down. Then panic begins. Everyone sells because everyone else is selling. It becomes an emotional roller coaster, not an investment market. China's stock market became much more active again over the last 2 years. But it wasn't because millions of people suddenly discovered Warren Buffett. 3 things happened. First, the government began strongly supporting the stock market. New policies, lower interest rates, more liquidity, and public messages encouraging confidence all helped improve market sentiment. Second, many traditional businesses have struggled. Real estate slowed down. Consumer spending became weaker. Many small businesses found it harder to make money. When people cannot find good opportunities in the real economy, they naturally look toward the stock market. Third, there is AI. If you open financial news today, AI is everywhere. NVIDIA, robots, semiconductors, large language models. Every week there seems to be another company that will change the world. Many people start thinking, what if this is the next NVIDIA? Nobody wants to miss the next big winner. Fear of missing out is a very powerful emotion. These 3 things brought millions of people back into the market. Unfortunately, they did not turn gamblers into investors. Here comes my favorite part. Some people trade so often that their weekly trading count may be higher than Warren Buffett's lifetime trading count. Think about that. Buffett has invested for more than 70 years. He has only made a relatively small number of major investments. When he finds a great company, he may keep it for 10, 20, or even 30 years. Meanwhile, some traders buy a stock at breakfast, sell it before lunch, buy another one after lunch, and sell that one before dinner. If clicking a mouse made people rich, professional gamers would be the richest people on earth. The funniest thing is, some of these people actually make money. But if you ask them why they made money, they have no idea. I was lucky. My friend told me. The group leader recommended it. Ask them to repeat the same success next month. Most of them can't. That isn't investing. That is winning the lottery. Real investing means understanding why you made money and being able to repeat the process. Otherwise, the market usually takes the money back, sometimes very quickly. Warren Buffett once said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." Many people think this is just a famous quote. It isn't. It is the basic idea of investing. When you buy a stock, you are buying part of a real business. Not a green line on your phone. A real company, with real employees, real customers, real products, and hopefully real profits. If the business keeps growing, your investment has a good chance of growing too. The stock price is just the scoreboard. The company is the actual game. Many people spend all day asking, "What should I buy tomorrow?" Successful investors usually ask different questions. Can this company still grow 5 years from now? Does it have a competitive advantage? Is the management trustworthy? Is today's price reasonable? These questions are not exciting. Reading financial reports is not exciting. Studying businesses is definitely not exciting. But building wealth was never supposed to be exciting. The stock market rewards patience much more often than excitement. One final thought. The most dangerous investor is not the person who loses money. The most dangerous investor is the person who makes money by pure luck. Because losing teaches you something. Luck often teaches you nothing. If you need someone else to tell you what to buy every single day, you are not investing in companies. You are investing in someone else's confidence. And when things go wrong, the losses are still yours.